Hello, everyone. Welcome back to Boss Economics World, your trusted source for incisive analysis of today's economic policies and their impact on our daily lives. Today, we're unpacking inflation, economic growth or lack thereof, and the frustrating incompetence of runaway government policies. There's a buzz in the economic world as economists expect inflation to have slowed, albeit with certain cost categories, like used cars, remaining problematic. Now before we dive deeper, here's a big elephant in the room. The reports indicate slower inflation growth, but make no mistake, folks. The reality on the ground is quite different for millions of households and businesses feeling the pinch of stagnant wages, soaring prices, and a bleak economic horizon. Sounds familiar? First off, let's tackle the Consumer Price Index, CPI, and the core CPI. Economists in a Bloomberg survey predict that prices rose by about 0.1% for CPI and 0.2% for core CPI in September. On the surface, these numbers seem pretty low. Do they suggest that the battle against inflation is being won? That might be what some headlines want us to believe, but dig deeper, and the story is far less rosy. On an annual basis, inflation still increases by 2.3%, and the core CPI remains stubbornly high at 3.2%. So, the numbers reveal that price pressures haven't really disappeared, they've just shifted around. Now, here's where things get particularly tricky. On paper, we're reaching the slowest inflation pace since early 2021. But ask any ordinary consumer or small business owner, it certainly doesn't feel like inflation is slowing down in the real world. Key areas like used cars, which the report highlights, continue to push upward. But is it just used cars? Not at all. Just wait until a broader range of goods starts climbing again as higher shipping costs trickle through over the coming months, a direct consequence of container shipping prices nearly doubling earlier this year. So, what's the reality behind these numbers and why does it matter? Let's break this down bit by bit from a wider perspective, as inflation doesn't appear spontaneously out of thin air. The backlog of supply chain disruptions, spiking logistics costs, and higher wage demands are all in play here. Remember the wild surge in shipping costs earlier in the year? Of course, these costs don't just evaporate into thin air. They trickle down into the products we buy. Bloomberg's prediction program is more sedating than helpful, telling consumers that the price hikes will lag by about 6 months. It's Dante's Inferno. But for the economy, stay tuned for this grinding inflation roller coaster stretching out well into next year. Take this analytic gem. Used cars are expected to cause a hiccup for core goods, which economists argue discount CPI inflation. Used car prices dropped for months, but are now kicking up again, taking consumers for a spin on an undulating roller coaster of anxiety. It's as thrilling as watching your savings disintegrate. Combine that with persistently high costs in car insurance, which somehow never seems to come down, regardless of the broader economic trends. And you can begin to appreciate why headline inflation slowing means precious little when basic goods and secondary needs remain expensive across the board. Next, let's talk about wages, often hailed as a good sign of economic health. However, wage growth, especially at the levels we're currently seeing, can be a double-edged sword. Wage growth, which fueled consumer spending somewhat during August, leaves a trail of confusing consequences behind it. On one hand, real earnings rose in August, which would sound like good news, but it's coming too fast for services sectors to absorb efficiently. There's a reason economic watchdogs are worried. Heavy inflation in wage-dependent services like healthcare carries too much momentum, and it leads to another core risk. Now, for some context, we've seen nearly 50,000 dockworkers negotiating higher wages, but the price for this wage hike is being passed on to consumers in some form. Meanwhile, other major wage negotiations are ongoing, such as Boeing's large-scale labor contracts and the United Auto Workers, UAW, strike. These upward pressures on wages aren't confined to isolated pockets. They're system-wide shocks getting pumped into households, service providers, and businesses. Let's zoom out further and consider the Federal Reserve's response to all of these moving parts. Yes, our dear friends at the Fed, constantly walking a tightrope to balance interest rates, inflation, and so-called economic growth. The report suggests that even if core inflation surprises on the upside, it won't drastically change the Fed's decision-making path since inflation's broader trend remains downward. As Anna Wong from Bloomberg Economics predicts, a 25 basis point rate cut may follow November's half-point reduction. The Fed's cautious choreography of raising rates to control inflation, while being mindful not to completely torpedo economic growth, is clearly a high-stakes gamble. The Fed is squarely in a catch-22, as persistent wage gains and rising consumer costs undermine any effort to declare inflation controlled. Let's face it, the Federal Reserve's tightening grip has already been felt painfully by small businesses with soaring borrowing costs, and the services sector, which quite frankly, can't take much more heat at this point. At the core of the Fed's conundrum lies one question: pause rates and hope inflation sorts itself out, or keep hiking and risk causing the deeper recession everyone's afraid of? None of these outcomes leave everyday folks or businesses in a better spot. We need clear, decisive policies to overhaul market inefficiencies, not just the old mix of vague economic projections and hope. Let's consider the broader corporate picture. Large businesses have embraced inflation as an opportunity to, you guessed it, raise prices well beyond their costs. While Bloomberg and others may tell you that inflation is driven by supply chain tangles or used car prices, there's another key player: corporate profit-taking. Take note of the fact that many corporations have enjoyed earnings-beating margins, sometimes far outstripping their actual inflation-driven increases in costs. We've seen companies in sectors from hospitality to tech raise prices and blame inflation, but in reality, some of those industries have been cashing in on the spectacle. Airlines were relentless in upping ticket prices even as fuel prices fluctuated. Real estate and property management companies have continued to hike rents even as construction costs softened. Ironically, while wages are rising and supply chain issues impact certain goods, corporations have cleverly capitalized on consumer sentiments of inflationary necessity to inflate prices unnecessarily. That's right, folks. It's a crisis of capitalism, not just CPI, when corporate greed masquerades as inflation. Look, let's be honest about the national disconnect. Economists are good at dealing in models and charts, talking about lag effects, core measures, and forecasts, but this never tells us the human toll, the people watching their grocery bills explode despite all this talk of disinflation. They're staring at shrinking paychecks while effective price increases climb month by month. You won't see that immediate reality in Fed reports, national statistics, or CPI breakdowns. Take a step back from these fancy forecasts and glossy charts, and imagine life from the perspective of inflation outpaces your wage growth. Health service costs are spiraling out of control. Essential goods are becoming luxuries. Sure, nuances matter, but your wallet doesn't care about statistical lags. When it's hard to afford groceries, whether inflation jumped 0.1% or 0.5% hardly matters. Financial insecurity doesn't wait for econometric models to play out. This brings us, finally, to the core critique: a lack of coherent economic leadership. When you've got the Federal Reserve pushing conflicting signals while the government racks up spending on ill-planned programs, what else can we expect but systemic failures? The world's leading economies, especially the US, are running on outdated policy frameworks, while cutting rates on the back of spiking inflation. Where are the long-term plans for robust wage management, tackling corporate profiteering, fixing critical infrastructural bottlenecks? The current regime doesn't provide serious solutions. Instead, they give us bubble-wrap solutions in the form of reactive Fed responses and minuscule interest rate shifts. They've left out the most critical fix: curbing unchecked corporate behavior while ensuring wages rise sustainably. So what's the verdict? While the CPI numbers hint at slower inflation, this is no rosy forecast for real people. The illusion of control by the government and the Federal Reserve is fragile at best. They are patching holes in an economy that continues spewing trouble from every corner. The structural issues are deep-rooted, and unless there's a change in the fundamental economic approach of policy, we'll continue living in the perpetual cycle of rising costs, labor disputes, growing inequality, and yes, more inflation. Economists may be breathing a sigh of relief as these figures roll in, but out here in the real world, people continue to bear the brunt of short-sighted policies, lackluster reforms, corporate excesses, and an economic system increasingly out of touch with what citizens actually need.